Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten. Jumping into the charts on this August 15th, kicking off the new week. Once again, the same summer doldrum light volume float up has occurred. Obviously, the markets yet again having another positive update is putting the risks more on the balance of probabilities that we should see some downside. You can clearly see on the S&P 500 daily chart here that we have tagged significant resistance. Now, I'm going to show you the SPY chart and the SPX chart just because they are slightly different in variation but very, very similar. But overall, tagging the 200-day is acting as should be some short-term resistance. I don't think you're going to slice through that. However, if you do, you have this downsloping channel. Now, the saving grace for this market is the fact that the volume has been anemically light. And when I talk about anemically light, today we traded 53.8 million on the spiders. You know, on Friday we traded 61, previous day 68, 44 million, 54. So basically this whole float up since this bottom over here has just been very, very light. And if you notice the degree of this angle, it is very, very, very strong in the sense that to sustain this type of move up over the longer term period is certainly going to prove to be a difficult task. Now, we did come from oversold levels, so that's why you're getting this classic bear market bounce. But if you simply take a measurement tool and measure the bounce that we've had now in the S&P 500, we've almost sufficed a 20% bounce in the S&P 500. So that's pretty impressive considering the market conditions have arguably deteriorated despite people getting, I would say, ambitious with the fact that this market is setting new highs. And when people are ambitious because inflation has rolled over, well, if we simply analyze the market moves here, I would argue that this move from January to down here and all the way up has been your, I would argue from this period here to your low, this has been your inflationary scare move down. And now that inflationary in the short term has looked like it has peaked from 9.1 to 8.6 and slowly retreating, that is giving a lot of hope for investors. But I think this market is going to have roughly 4 stages down. We've witnessed the first stage, which is from your high to your low here, which was the inflationary stage. Took a lot of power or a lot of wind out of the sails of this market. And now that inflation is looking to somewhat retreat from the highs, we have by no means got it under control. And by this bounce, it's seemingly priced in that investors think the Fed has inflation under control, when realistically, to bring inflation down anywhere close to their mandate is going to require a lot more pain. And as equities rise, this continues to put inflationary pressures on the CPI and PPI. So overall, I think the inflation wave has kind of passed and been priced in, but we're still going to see a second, third, and fourth wave down, in my opinion. I think the second wave down is going to be the recessionary pricing. And once that recession finally takes hold in terms of sentiment, I do think we're going to see another sharp move down in the overall indices. And one of the things that I'm keeping an eye on is that manufacturing index. We saw a survey from the New York Fed, I believe, and the survey was one of the worst declines in the manufacturing survey. I think it was the second worst decline in stock market history. Consensus was supposed to be 5.5% or 5.5 points up on the survey, and it managed to decrease by, I believe it was 32 points. So that is an exceptional contraction in the overall manufacturing sentiment and survey, and that is going to be a key guide. Will that start to boil over and spill over into the PMI reading? That is something that I'm certainly going to be taking note of. I'll have to try to find out when that PMI release is. I believe it is sometime this month, but I'll have to double check my notes. So overall, the S&P has tagged that 200-day, so pretty impressive move. Your next resistance is this downsloping channel. If the volume continues to stay light, it does continue to favor that initial float up, but eventually I do think we're going to get some sort of a mean sell-off that comes. If you look at the SPX, which is also the S&P 500, notice how you have not touched or tagged the 200 daily moving average on the SPX. The interesting thing though is you have hit the top of this parallel channel, and you've also filled this key gap fill today. So that is a big time level on the SPX. You have two technical resistance factors that are aligning, a technical gap as well as the top of a resistance channel. And then if you start to slightly poke above that, you have the 200-day bearing down on you, and you also have this downsloping parallel channel. So perhaps the markets can go to test and a little bit higher than 4,300, but again, they are on borrowed time. We have seen this float continue, but once that volume picks up, I do think we see a heavy sell side action. And the interesting thing today is, I mean, if you read some of the headlines, Michael Burry of The Big Short, he actually dumped all of his previous stock holdings, and he kept one position, but he dumped many names like Meta, Amazon, I think Microsoft was in there, Apple. So many of the big cap stocks he actually dumped today, and he's no longer holding. So that should be somewhat of a sentiment gauge. This is an investor who's been around the block, who has been through recessions, who has been through bear markets, and the fact that he is dumping all of his positions at a very solid level in the charts after having a significant bounce should not be ignored, should certainly be monitored. If we look at the QQQ, the NASDAQ, you can see that it has not met the relative strength that the S&P 500 has met. So notice how you have not recaptured the 50% retrace, but as opposed to the S&P, you're trading above it. So the NASDAQ, you could slowly start to float up a little bit more. You're still very close to that 200-day moving average. But again, same sort of scenario. Markets are on borrowed time, and it's just a matter of time, I do think, before we start this next down leg. At least, at the very minimum, we need a big consolidation range to digest this move. We have some key gap fills down here, and then you have a major support here at 314. So overall, we do need to see some consolidation if this move is supposed to be sustained and healthy. And yes, we've been saying that for a little bit now, but with this light summer doldrum volume, it has certainly been just a free float up in the markets, and there's not much resistance in the sense of sellers stepping in at this point in time. But since the volume is so light, this is kind of making me think that this is sort of a short covering rally, and there's not really much buying pressure that's occurring. There's not much selling pressure that's occurring either, but the shorts that are covering are willing to keep this market afloat for the time being. And the interesting thing is, as people dump their shorts, that tends to when the market starts to roll over, because people think, oh, I don't need to short the market anymore, it's going to go up, and then that's when things start to take a turn for the worst. So another important sector I want to touch on is the ITB, so the home construction. And the home construction is important because basically if we compare, this is when the ITB had to really start its next sharp down leg. So from the 18th of March up at this high here, you had a pretty sharp sell-off down here to April. And if you notice, the S&P actually only topped around the 29th of March, so on this candle right over here. So the ITB is kind of a leading sector to show that, okay, potentially we've put in a top. If we've put in a top, this should start falling. The S&P may have a few more days of upside before it starts to roll over. So generally this is a leading ETF, and the home construction, I do think we'll see some downside. One of the reasons I think we see downside in the home construction is that you're tagging this parallel channel, which has major pivot, pivot high here, your consolidation before breaking out, basically your retrace where you had another pop above that channel, consolidation before breaking down, tagging this level twice as resistance over here, coming down, finding support, consolidation, support, and then you triggered and broke this, and now you've recaptured this channel to the upside, and you've actually tagged the top of this channel once again. So I do think it's very interesting to see that we did make a new high on the day, so the ITB was positive, and it actually closed negative on the day, down 0.49%. So considering we had a pretty much a broad market rally from the open, stocks did gap down pre-market. Certain sectors, energy was under pressure, but from the open, pretty much every stock floated up and turned positive. And if you ignored the gap down in pre-market, most of the sectors did have a positive rally on the day. That being said, energy was down on the day, but from the open, it did continue to rally and rally and rally. So the fact that all the sectors continue to push up throughout the course of the day, but the ITB actually pushed down, this might signify that we have a near-term top. And if it's anything like the March 29th sell-off where the S&P topped, this could be a potential top that signals in the ITB. And then you had 1, 2, 3, 4, 5, 6, 7 days of trading before the S&P put in a top over here. Let me just bring it up on the charts. Let me just pull it up over here on the 29th of March. So the S&P put a top here on the 29th of March, as opposed to the ITB put in a top here just slightly before on the 18th of March. So it's going to be interesting to continue to monitor this ETF. If we start seeing downside in the ITB, it likely means that we're going to see a rollover in the indices sooner rather than later. So into resistance on the ITB, we'll just monitor this as is. There is a gap fill around the 63.50 area, which I will be looking to add to a position if we somewhat float up there. But at this point in time, we'll just have to continue to monitor that. Natural gas, really interesting price action because you did have an initial dump lower on natural gas. You can see that you dumped all the way down to 838, and you had a beautiful reversal to finish positive. So natural gas was down 3 or 4% at the lows, and you had this impeccable reversal. So that is short-term bullish price action. You're still in a little bit of a premature pattern here, being that this could be bullish consolidation. If you get a few more days, it looks like natural gas could push up to test this double top region and even likely pierce that zone. So we have a started position in the KOLD. I'm very comfortable at accumulating a short at this level. At the 967, we'll look to add or pierce of that level, and then 1040 is another big level I have priced in and calculated. I think the big loser on the day was oil and energy stocks. So oil took a nasty sell-off, and I remember that we were going to see this initial drop. We covered our short. I was skeptical about starting another short over here, but we should have. We probably should have. Hindsight's always 20/20. I just didn't think there was enough risk to reward, but I did say it's very likely that you have this bounce. You get a retrace back to these major pivots, which was your initial war sell-off dump. So you retested that zone, bounced off of it, had a nasty red bar down today, and you're back at the support level. So the longer you linger here and tag the support, it does favor a move down. Again, you do have support at this previous pivot, 85, but if we look to consolidate above this level, this $85 level where there's arguably a lot of buyers sitting because it's your pre-pivot level, your major pivot level over here, if we consolidate above this, it's likely that we slice through that level with ease, catching a lot of people off guard. So I'm not going to be looking to buy this 85 level. I originally had that level as a big buy, but I'm not liking that level anymore, just in regards to what the current price action is shaping up like. So if we take a look at gold, let me bring up the gold chart. Gold, obviously it was down on the day. I think that's part and parcel due to the fact that the US dollar was up, the DXY. So again, you're still in this bullish consolidation. I would have liked to see a close above the 50-day moving average, but you closed below. So gold always has a historic price pattern of having wild moves in the week of options X. So options X is Friday, where many options will be expiring, worthless, and institutions will look to seek that max pain level for the retail traders, which they're very successful and powerful at doing. And that's going to be a big indicator in the precious metals, because generally the precious metals also have a lot of options expiration that occurs, and this could whip the price back and forth. But you're still holding this bullish consolidation. You can see that you've tagged this down sloping channel. Our first major resistance was this 1805 level, which we tagged to a T, and now you have to consolidate in this upper range before it looks like you can push higher. If we take a look at the DXY, it was really interesting to see how powerful the DXY is. you arguably have a short-term breakout. Tomorrow will be confirmation on the DXY. If we get confirmation on the DXY tomorrow by closing above this close today, then it looks like the DXY can easily push back up to this double top zone. So that's going to be a significant area. Watching for confirmation tomorrow. If the DXY confirms above this high close tomorrow, the indices and overall equity markets could be in for some rough selling ahead, because the DXY means that people are moving to cash, people are liquidating. To move the DXY up 0.77% in one day requires a lot of demand for US dollars and cash. So let's just continue to monitor this. It's very rare to see a correlation where the US dollar has a strong move up and the US indices still move up along with it. Now, correlations do break at times, but when you have a plus 90%, I think it's a plus 95% correlation, that correlation tends to mean revert back to the norm. So let's continue to monitor the US dollar. I think if this continues to push up, that's going to be our telltale sign that the indices are going to be starting their next leg to the downside. And let's just continue to monitor, for instance, March 29th over here on this red candle here is when the S&P 500 basically started its next down leg. So if you look at this level here, the dollar bottomed basically over here on the 31st of March. So 2 days after the S&P topped and started its nasty down leg. So we're talking about this down leg here, the 29th, the S&P topped and started a nasty sell-off. And if you look at the DXY, it bottomed and basically did an inverse move of the S&P 500. So that's kind of where we're at now, is if this has found a short-term bottom and if this continues to power up, we will certainly see pressure on the indices moving forward. Let's take a look at Bitcoin, shall we? So Bitcoin looks to be running out of steam. The longer grand pattern is certainly a bear flag. If you look at this is a classic bear flag. You take this low to this high. This is all inside bar, inside this wide range red bar consolidation. Upsloping parallel channel favors a move to the downside. If you simply had to calculate this breakdown of this pattern will take you somewhere into, let's just throw up some fibs and do a rough calculation using the software. So this pattern, this downside move, is certainly one that takes you very, very far down. I mean, simply a 618 retrace is going to take you down to 6,200. So that's certainly a long way down on Bitcoin. But overall, once this bear flag breaks, that's going to be a nasty, nasty, nasty sell-off with that bear flag. I mean, we saw this bear flag break over here on the weekly chart, and look what it led to. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out of 13 weeks down in a row. That was fierce, and it certainly looks like there's lots of sellers stepping in. If you notice over here, wicks, 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 wicks. That means the sell pressure, as we're getting up to this level, sellers are stepping in. Sellers are stepping in. So clearly that 25,000 level is a massive, massive resistance. I thought we would at least challenge this pivot. And I mean, we still can. We still could. I mean, we did come very, very close to doing it. But overall, if we keep seeing these wicks forming, that's going to be a little bit of a bearish signal to me that there's not enough buyers that are there that are to overpower the sellers. And when you look at the actual float up in the S&P 500 and the NASDAQ, if you measure this low to this high, Bitcoin has had a very, very weak float up in comparison to the indices. This is an asset that's supposed to be moving substantially faster with extra alpha, but it certainly hasn't. I mean, if you look at Ethereum has had an impeccable move off the lows, pretty much almost over double. Starting at 888 over here, going all the way to a high of over 2,000. That is a substantial run on Ethereum. You have recaptured this downsloping parallel channel, but overall, if we look at the larger time frame, you've had 1, 2, 3, 4, 5, 6 weeks of upside. That's a time count, and now it's looking to be that you're either going to put in a little bit of consolidation if you tend to move higher, but my theory is that we're going to start to see cryptos roll over pretty quickly and sharply here, especially once the indices start to roll over. I think the indices have been the one thing that's kept crypto up. just due to the amount of fear in the crypto space with bankruptcies and scams and whatnot. There's certainly a lot of risks in the crypto space, and I think that's why we haven't seen a robust bounce in Bitcoin. I mean, Ethereum's done a mere double, so that's pretty impressive, but overall Bitcoin has been lagging in terms of the crypto space. I'm just going to look to see if there's anything else I need to discuss. I mean, we could take a look at the US 10-year yield. There's not much to report there, but if we look at the yields are still challenging this old neckline, which has been negated. So you can see you're still at support. You have this downsloping trend line. We failed to confirm a breakout. You did not get a confirmation candle, but needless to say, you have retraced back to the breakout zone, and now it looks to be that maybe we can get a push up in yields. I think if we get a push up in yields, that will surprise and shock the market pretty drastically. Not us over here at Trading Capital, but I do think we need a move up in yields to continue to see inflation come down, and I think that's certainly what we're going to get. I know the bond market is calling for lower yields, and many people think the Fed is pivoting already, but the pivot doesn't usually happen this fast, and there's certainly the past cycles are not signaling that the Fed is pivoting yet. I think the markets are hoping that the Fed is pivoting because there has been so much pain in 2022 thus far. Obviously, if you take away this bounce, you have recaptured more than 50% of those losses. For some, not everyone, but a lot of people are over optimistic that the Fed is going to pivot, and I just certainly don't think the pivot is coming quite yet. I think we're going to see another move up in yields, which will correlate perhaps with a rising, stronger dollar, which is going to put that tremendous amount of pressure on the overall equities. So that's it for today's video. I hope all this analysis helps. We'll just continue to monitor the charts. There was really no action today, no sell alerts, no trade alerts. It was a pretty quiet day. Even day trading, I had some energy levels, but those really didn't play out and get down to our levels. But overall, let's continue to see. S&P touching the 200. That's intriguing. Obviously, the Russell touched the 200 and now closed above it. So that's also pretty intriguing. But if you notice, the Russell has not recaptured that 50% retrace despite it trading now above the 200-day moving average. So clearly the S&P has a little bit more relative strength, being the fact that it has recaptured 50% of its down move, but yet it's still trading under the 200-day moving average. So a couple correlations that we'll continue to watch. I think Europe could be a major player in the sense that they have a lot of economic data released over the next 1 to 2 weeks. So let's see how Europe fares in the sense of their GDP and economy and manufacturing and inflation and whatnot. And we'll just see if that tends to shake up the market and create some opportunities here for us at Trading Capital. Thank you all for being members. Please give this